Good afternoon once again, and thank you everyone for joining our webinar this afternoon. My name is Peter Kibe in Brand and PR at CIC. We are glad to have you on board for this very important discussion this afternoon. Happy to see most of you switched on for this very important discussion on financial decisioning in tough economic times. When we have our host ready to go and our speakers ready to go. So before I invite Mudhani, I will pray so that once I hand over, we just kick off our discussions this afternoon. So allow us, as per our tradition at CIC, to bow down for a word of prayer. Thank you, Heavenly Father, for this afternoon and the opportunity you've given us to learn and to educate. As we tackle the matter that is ahead of us, dear Lord, we pray that you guide our thoughts, guide our discussions. Lord, we may elevate and edify you in everything that we do. Accept our prayers this afternoon. In Jesus' name, pray and believe. Amen. Mudhani, our host, over to you.
Thank you, Kibe, for that. Just for people to see who Mudhani is, I'll be your host for this webinar today afternoon. And good afternoon, ladies and gentlemen, and welcome to our webinar. Our theme today is financial decisioning in tough economic times, which is quite, timely, given the situation we are in as Kenyans. We're having elevated inflation. We're getting new taxes every day being levied on us, new levies, and a lot more things that are being deducted from our income and our businesses. So we're in a tough economic time, per se, and some are even losing our jobs. We did see announcements about some companies that are cutting jobs. So what to do? And that's what we're here to discuss, what to do when we're in a tough time. And just before we get there, allow me to put off my camera and get into a little bit of an icebreaker, and as well as telling you a bit about who we are. Right, so we are a financial services group with footprints across Africa. That is headquartered in Kenya. We have exposure in Uganda, in South Sudan, and Malawi. And we are in the life business, which includes, group life business, ordinary life business, as well as pension. We also have a very strong general business model with us. We have medical, amongst the strongest in the country. We also have motor, professional indemnity, home and fire insurance, all sorts of insurance, and pretty much we're able to cover from a life and general perspective. And ultimately, today it is the asset management side that is hosting the webinar. And I'll just give you a bit of history about CIC Asset Management. So we were incorporated in 2007, and we began operations in 2011, and we have over 85,000 customers. So thank you for believing in us and trusting us with your investments. And in terms of assets under management, we have over 135 billion. So again, thank you, dear clients, for trusting us with the investments. We continue to grow because of you. And a key benchmark and a key, thing that we've been able to achieve, we are the most profitable company, and we have been the most profitable fund manager, rather not just company, the most profitable fund manager since 2020, and we continue to do so. So we are efficient in how we do things, and we're able to generate, attractive returns. And we continue to be the market leader in unit trusts with over 40% market share. So we'll go on to our icebreaker. We have a quiz, and these are the rules of the game. So I will ask a few questions, and to be able to win, we want you to type in the correct answer in the chat section. So whoever types in the first and correct answer wins. And then any response, if you put in the Q&A or you unmute yourself and answer, that will not be considered. So we'll only consider responses that are in the chat section. So I hope you're ready to go. All right. So the first question, and we will be giving a prize. Sorry, I should have mentioned that. We will have a prize for the winners for this section. So the first question, true or false? The Nobel Prize in Economics is not a real Nobel Prize. I repeat, the Nobel Prize in Economics is not a real Nobel Prize. I can already see answers coming in. Keep them coming, keep them coming. Is it true or false? Is the Nobel Prize in Economics real or true? Is it real or true? Okay, I think we have enough. We have sufficient responses. And the winner goes to Patrick. And the answer is false. So you are right, Patrick. The Nobel Prize in Economics is actually not a true Nobel Peace Prize. So just giving you some history, unlike the original prizes, the ones in physics, chemistry, psychology, medicine, literature, and peace, this prize, okay, English is a second language. This prize was actually established by the Swedish Central Bank in memory of Alfred Nobel. So whoever said false, the first correct answer was Patrick. So kindly send us, we'll get in touch with you in a bit to get your details and get your prize, your branded merchandise from CIC group. So over to the next one. So how much do you know? According to the Kenya National Bureau of Statistics, yeah, so we are an economics firm. So of course we'll have to bring economics into the picture. What is the annual inflation for the month of August 2023? According to Kenya National Bureau of Statistics, what is the annual inflation for the month of August 2023? I can see some people who clearly follow economics and what's been happening. Let's give a chance to those for the rest to answer. Okay, so the correct answer is 6.7%. And John Wesley Chege, you are the winner for our second question. The inflation rate for the month of August is 6.7% according to the Kenya National Bureau of Statistics. So now you know. If you didn't know, now you know. So I'll go to the next question. This is the last one for this session. So again, according to the Kenya National Bureau of Statistics, which is the richest county in Kenya? According to the Kenya National Bureau of Statistics, so which is the richest county in Kenya? So the KNBS issued a county, a GDP per county. Interesting statistics there. So it would be nice to see what you think. Which is the richest? All right, you can see people are just putting the counties that they come from. Not bad. Yes, represent the county you come from, and though it is unlikely to be the richest, but well done. Well done for being, faithful to your county. All right, so the first correct answer, the answer is Nairobi. And this is by Festus Chesire Kiprop. However, he has written Nairobi. So should we forgive him and give him, or do we become strict and say the first answer is by someone else? So I think we will forgive him. The thought was right. So Festus Chesire Kiprop, you are our winner, our third winner. We will get in touch with you. If the first winner could give us more details about yourself, give us your full name, it will be easier for us to get in touch with you. That is Patrick. Please give us your full names and we'll be able to get in touch with you and continue. So just words of wisdom. Our theme is financial decisioning in tough economic times, and making decisions is a key thing. So just some words of wisdom from Gordon Graham. He says, decision is a sharp knife that cuts clean and straight. Indecision is a dull one that hacks and tears and leaves behind a rugged edge. So the thing here is you should be able to make a decision. And what is CICAM doing for you? We're giving you information, giving you insights, and enabling you to make the right decision, given the tough economic times that we are in at the moment. And even as we give you insights and information, we leave you with the words of Nelson Mandela. He says, may your choices or your decisions reflect your hopes and not your fears. So what information does is it enables you to make calculated decisions, as opposed to decisions based on fear. So indeed, may your choices reflect your hopes and not your fears. So allow me to invite our first speaker. His name is Kennedy Shege, a very intelligent and young man, very eloquent in his speech. He'll be giving us some insights on what's been happening in the economy. And then we will be able to talk further after that. So welcome, Kennedy, and thank you for listening to us, dear audience. Over to you.
Good afternoon, everyone. My name is Kennedy. So I'll start by thanking Muthoni for that lovely icebreaker. And I also want to thank everybody who was tuned in today. It's a hot afternoon. You could have been elsewhere, but you've chosen to at least have this discussion with us. So truly appreciate your time and your ears. So without further ado, I'll just share some slides and kick off my presentation. So the topic today is financial decisioning in tough economic times. Essentially, we are all cognizant of the fact that we are not living in normal times, and there's a lot of volatility or a lot of things that are different to what we used to experience before. And essentially, there's some few bullet points we just point out, when we're saying tough economic times, what do we mean by that? So, in terms of the cost of capital, it's at a historical high. By this, essentially just means that, if you go to the bank to get a loan, if you're trying to, get some capital to start a business, it's not quite easy. It's expensive, and it's, to be quite frankly, very hard. High inflation has also eroded household incomes and squeezed business margins. I think there's a joke going around. You go to the supermarket with 1,000 shillings, but it feels like it's less 10, so it feels like 100 bob, and we're all feeling it. We've seen new taxes which have increased burdens on households and businesses. So the finance bill, which kicked in, essentially has a new array of taxes, and we are feeling them both as businesses and households and individuals. And the implication of all of this is that consumer demand has been eroded by this. We mean, you have, as a business, you have less capital to work with. As an individual, you have less income or less, sort of money to spend. And this is mainly because, taxes are now eating into your income. There's high inflation, and also there's cost pressures for businesses. And, all these factors, are just hitting so hard and so fast. So essentially, we want to take stock. How did we get here? What's been happening, and, just a bit of reflection. I know sometimes economics can sound a bit, very detached, but we'll just try and, give this as a story and, just reflect. Of course, there's many factors that go into this. Sometimes this can be, there's so many moving parts, it's very nuanced, and there's so many complexities that go into what we experience in day-to-day life. But we'll just touch on the, the high level factors that, brought this about. So I'll just take you back a bit. So I wanted to maybe perhaps think about two key dates. This is March 15th, 2020, and 24th February 2022. So March 15th, 2020 is when officially the country went into lockdown. Restrictions were put. We were all, sort of stuck in our houses. Business activity was halted, and we weren't doing much, and not just us, also globally. So what came about with that is that in terms of GDP, output from economies, the global economy, it really dipped. So you can see there was at least a consistent trend up to 2019. And then in 2020, there was a significant dip, which was expected. I mean, if we're not going to work, industries are not producing goods and products, and also for the services industry, of course, economic activity is going to dip. Now, come 2021, there's a resurgence. Everybody is now at least trying to get back to work. Output industries are manufacturing again. And, because the previous year there wasn't any activity happening, there was a huge rebound globally. Now, how did that come and bring about inflation? So you see, in 2020, inflation wasn't that significant. It was more around the historical trend. So come 2021, restrictions are now easing. And also because restrictions are easing and people had been in their houses, not spending their money, they're now going to the shops, they're trying to travel, they're trying to catch up with its businesses, with orders, consumer demand, and all of this pushed the prices of goods up. Also, another thing that's happened is that a lot of developed countries' governments, also including locally, we saw governments coming in, pumping money into the economy to sort of revive economic activity. So this is to try and, minimize any economic slowdown that could lead to unemployment, or sort of just to boost the economy. So they pumped in a lot of money. So given that, and in 2020, people, in as much as there was unemployment, people lost their jobs in 2020 after the restrictions came in. In 2021, people had saved up some amounts of money which they didn't utilize in 2020. So people are coming out, the economy is up and running, people have a lot of cash, the government has pumped in a lot of money into the economy. That means that there's so much money going around and people are going to the shops, there's so much demand, the price of everything started sort of going up. In addition, because in 2020 not much had happened, there was a backlog of economic activity. So think of your supplier who had to shut down his factory and he had orders before lockdown came in. So there was this sort of effect of they're trying to meet old orders and also meet new orders. So in 2021, that's where really we see this sort of spike in global inflation. And, from a historical perspective, it was significant. But if you look at the 2022 graph, it's not as high. So what happens in 2022? So now restrictions are easing almost everywhere. So we're talking about China, because China, which is a key leader of demand, was now also easing its restrictions. Additionally, something else happened. The date that I mentioned about 24th February 2022. Russia-Ukraine happens. That's when there was a full-scale geopolitical crisis, and this affected basically the entire globe because both countries are key suppliers in major commodities, from grains to oil to steel. So, and now that they're unable to feed into the global supply chain and also energy because they are very mineral rich, because they're unable to feed into the global supply chain, the prices of everything skyrocket. So given that, also locally, we are very connected to the global economy, this really now also cascaded. But that's on the global economy. How about Kenya? What's basically been happening? So like I mentioned, March 2020, March 15, 2020. So that's when this is around here. So you can see that, the economic activity dipped. And we were still in our houses, and you can see the trend. By December, some restrictions had eased. If you recall, the hours were now more friendly. You could move around still later. And then now in 2021, we are almost fully reopened, and you can see there's a huge rebound in economic activity. Now, one peculiar thing I would mention about Kenya, the huge rebound was also driven primarily by a rebound in education-related activities. This is also when schools started reopening, and it contributed significantly to this economic growth that we're seeing. After that, it's been a gradual decline, as you can see, and around now Q1 2022, this is where we're seeing a sort of effects of the geopolitical crisis globally starting to eat into the country's gains. And just to mention about this Stanbic PMI graph, again, the two dates that I mentioned. So you can see at around March 2020, there's a significant dip. So this graph essentially just gives a sense of how business activity, is happening in the economy. It's a survey from big and small companies in the economy, and what's their view on basically their activity. So in March, we see a significant dip, which is rather explainable. As I mentioned, this is when you're going to lockdown, and then slowly we can see we're starting to go up as restrictions ease. And then at around March 2021, and this is actually April, some counties in Kenya did get fresh restrictions, but they were quickly reopened, and then we see another significant spike. Now, once we go into 2022, we can see here there's a bit of a dip, and this is in Feb. And then this is also because of the geopolitical crisis that I've just mentioned. But also we have to recall that in 2022 was an election year. So you can see that business activity is now just, slowly waning and declining. People are just adopting a wait and see approach. But by September, once, everything is calm, we see now again another spike. But now after September and then, going into the new year, there's a lot of optimism, but then again, the economic fundamentals are not making sense. So it does seem that these shocks that the economy has been hit by, are also dampening, business perception of, what they can get from the economy. And also, in addition to all of these shocks, we have to remember that 2022 was also an election year. Historically, election years have had low GDP growth. And so we can see that there's been a myriad of factors that have come into this. But let's also focus on another topic that's been, center stage in our economy, Kenya's debt. So, and I'll just point out these 2 years. This is where, the debt burden will spike. By this, I mean, this is when the economy, or rather the government, has significant debt maturities. So it has to pay its loans, and also interest payments. So basically the highest that it will have. So in hindsight, the government did, take on this debt to finance big ticket infrastructure projects, with the optimism that they'll be able to, recoup the investments and they'll be able to pay back this debt easily. But like I said, these shocks, even the finest economists wouldn't be able to predict them. So we have a concentration in debt in 2023 and 2024. And as I'll mention in a different slide about the Kenya shilling depreciation, the more the shilling depreciates, the more the debt spikes, because especially in 2024, a significant chunk of the debt is going to be USD denominated, and hence any spike in the depreciation in the shilling will mean that the debt stock, or rather the outstanding debt, increases. And also, just to mention, in 2024, this debt is going to be a one-off payment. It's going to be a bullet payment, which is going to be significant. So how does this feed into why we're feeling, how we're feeling when we go to the supermarkets, and why we're feeling like there's less money in our pockets? So in order to pay this debt, the government is ramping up taxes. These debts need to be paid from somewhere. So there's a lot of taxes that have been introduced to sort of finance this repayment. And essentially, this is, it's a buildup of issues. So we have, first of all, during the pandemic, and because of inflation, the government wasn't able to, pick up enough revenue to be able to, be at least have cash buffers before the repayment of this debt. But these shocks happened, and the current situation is that these debts are coming up, and we definitely have to pay them. So that's essentially now on the tax side why we are seeing sort of these effects. The government needs to ramp up these taxes in order to pay this debt. And if you can see how the debt has been evolving, it's been just a gradual rise, but up at around 2019, the increase has been rather significant, steep. Now, to talk about currency. So given in 2020, we went into this sort of lockdown period, there wasn't a lot happening. And, manufacturers did need to pick up where they had left off after the restrictions were eased. So they had all these imports they needed to make. So because of that, they were quickly looking for dollars. And in addition to this, you have to remember, everywhere else in the globe, there was a backlog of demand that needed to be met. So this meant freight prices, sea transport prices, even land prices, transport costs were up. So with all of this happening, the demand for the cost of imports was high, and now also the demand is high. So it just meant that the shilling, was going to get significant pressure. In addition to that, because there was a period of sort of inactivity, and also, like I mentioned, there was a stimulus package, economies that pumped money. They were now trying to reverse that and increase interest rates. So the dollar was strengthening, and now we are coming from a point of weakness where the Kenya economy is sort of demanding all these dollars, but the dollar currency is actually strengthening. So we see an erosion of our actual dollar stockpile. It went down. Also, speaking to the same problem of interest rates. So now in the global developed economies, Now, these countries are increasing their interest rates. So investors who are traditionally sort of come to a country like Kenya to, to invest surplus monies are now seeing that they're getting more rates at home. So why don't we just move our capital back? So there was a lot of a stagnation in inflows in new dollars into the economy, and also an increase in outflows. So the demand for the shilling was quite low and the demand for the dollar was quite high. So all of this, has been pushing the shilling up. In addition to that, there's been a parallel market and everybody's just, scrambling to get dollars. So yeah, it's been a situation of where there have been some interventions, but it's been a situation of where just the shilling has been rapidly depreciating. And now to just talk about inflation, and again, I'll just go back to the two dates I talked about. So we have here at around 2020, this is around March, we see that, inflation was rising, but in March, it starts dipping. Like I said, people are not doing anything, economic activity was basically frozen. So we have this sort of decrease in the prices of everything. And then slowly, as the economy rebounds, we have this effect of inflation increasing gradually. And then there was a bit of a dip, but again, in February 2022, we see now a significant spike. Now, this spike is also exacerbated by two things. There's the imported inflation. Global commodities are up. Kenya, we import wheat. We're basically a net importer. We import so many things, fuel, basic food commodities, wheat, which forms a large part of our staple foods. So because of this effect and the prices of these goods have gone up, they basically inflation just shoots up. And it's been on an upward trend until perhaps earlier this year, where we see a stagnation and a bit of a dip, and it's been gradually going down. But the outlook, perhaps, I know we've seen the revision in the fuel prices. There's still upside risks to this inflation. Now, the key things perhaps we can look at which really affects, how we feel in our pockets are food and fuel inflation. So we can see, in as much as the headline number, the main number, the aggregate number is 7.9, but food and fuel inflation are above the tens. And especially for food inflation, there was other factors. There was, climate change does have an inflation multiplier, and Kenya had gone through a period of drought. So with all these factors, if fuel inflation is up, it means, the costs associated with logistics are now high. So even transporting the food itself, you have to add that sort of transport, cost premium to food. And then there's a lack of there's inadequate supply of food in the economy. So, and for fuel inflation, it was basically, the price of importing oil was high, the shilling is depreciating. At some point, oil supply globally had decreased, so the price had increased. So we're seeing that it's a mixture of global and local factors that, have led us to sort of this situation. And but we do hope that at least there's talks of rains, but it could also go to the negative. If the expected El Nino is sort of intense, we might see damaged crops, but we just sit tight and wait. But inflation has been a key theme, and it's been really affecting households and businesses all the same. So with all those factors considered, what happens in the financial markets? Now, given inflation is high, when you're lending to the government, you don't want that you lend to the government for 1 year, you give them, let's say, 1,000 shillings. And because of inflation, what 1,000 shillings could buy you last year cannot buy you this year. You need the government to compensate you such that 1,000 shilling can buy the same goods and more. So what's been happening is, number one, investors are demanding more return. Number two, like we said, Kenya's debt situation is it's not the best. It's sustainable, but it could tip to the worst side. So investors are looking at the government saying, you're a bit risky. Can I give you this money? And if I'm going to give you this money, I need more return to compensate for that risk of you not paying me back. So all of this has been now cascading into the financial markets, and we've been seeing interest rates increase. Additionally, one of the government tools that it has to sort of contain inflation is to increase interest rates. So if it increased interest rates, it means people are going to sort of park more money in savings and not going to go out to spend it in a very basic way, not go out to spend it in the economy, which means there won't be a lot of demand or a lot of need for goods because people are not spending the money to buy goods and services. They are parking it in investments. So also the government has been sort of increasing its return or its basically its benchmark interest rates. So interest rates have been going higher. Also now, this is at the short-term interest rates, and also on the long-term interest rates, we see the curve looks a bit different as of June, but interest rates have been going up. And basically, this is because of the macroeconomic fundamentals that are currently happening in the economy. Just to briefly mention what's been happening in the equities markets, this is our local stock exchange. So like I mentioned, foreign exchange has become quite difficult to get. And so there's been two factors that are happening. Returns for investments in developed economies have been increasing. A large portion of our local stock exchange is dominated by foreign investors. So given now that they're getting more returns in their economies, they've sort of taken their a flight to safety in their, in their home turf. And so they've been exiting and selling the shares at sort of cheaper prices. And also because of the same, because of the current situation that I had mentioned, getting money, or rather getting dollars, Kenya shillings to dollars was hard. So for the investors who would have wanted to invest, they won't invest because they know I can invest. However, how will I be able to get my money out of Kenya? Or two, the investors who are trying to exit because they're foreseeing a sort of situation where they'll be able to remove their capital from Kenya, have been exiting at a rapid pace. So what it has meant is that prices at our local stock exchange have gone down quite significantly. But to get a bit granular and just to highlight some graphs on what's been happening for businesses, we are talking all these graphs, all these numbers, global factors, but for you who's, in a business or even for your household, just to see the real effects in the economy, just not sound too abstract, what's been happening. So these 6 graphs are a collection of a survey conducted by Stanbic called the Stanbic PMI. But so essentially they explain, they sort of give color to the real effects of this in the economy. So in terms of new orders, you can see that the trend line here is sort of going down. So businesses are not getting very many new orders for their goods and services. In terms of the input prices, we can see that the input prices have been going significantly up. So they are at sort of historical highs. It means that the cost of, operating is rather high. The output prices, it means that the pricing that they're using to sell goods and services is now up. In terms of the output in general, how much they're producing in terms of goods and services to sell on to customers, it's been on a downward trend. In terms of the stock of purchases, their purchases, rather what the inventory levels they're keeping in order to, to create the goods and services or to sell is not really healthy per se. It's at a flat 50. So it means they're not really expecting to sell much going forward because of the current environment. And also it means maybe they're cash strapped where they cannot purchase, stocks to sell. Now, in terms of their future output, so what do they expect? What sort of growth do they expect in terms of their sales of goods and services? It seems very low. It seems that businesses are really not optimistic. So, in a nutshell, we are saying it's not a very good, it's not a very good look. Households are reporting a lack of purchasing power due to high inflation and cash shortages. I mean, they're not having enough money to maintain the same standards they used to have before. Businesses are saying, business is tough. Inflation is high. Our input prices, the prices we need to operate are high. Our staffing costs are high. And, traditional ways of fixing these are not working. You cannot just maybe fire people and then increase prices of your goods and services. If you increase prices, people will just run away and try and find the cheapest alternative. Just firing people does not solve the core issue. So there's some few tried and tested ways that can assist in weathering through the storm. So perhaps it could be the right time for businesses to reevaluate and delay growth investments. So if you did have, or rather, you have a business or a firm did have plans to, enter new markets or make investments to grow, it would be prudent to rather reevaluate and check what return we get in this market. Is there enough demand for what we're trying to do? Should also invest in productivity to improve business efficiency. So just try and become more efficient in producing your goods and services. Try and keep your fixed costs low. Try and reduce your variable costs in order to to be able to manage to stay afloat. Now, even for households, it's probably prudent to dynamically review spending plans and budgets. It's very important to be agile. I would use just a very recent example. The recent fuel price increase was a huge shock to everyone. And perhaps you have a fixed budget that you allocate to fuel, and it would be very prudent to just revise it and not just wait and see, I'm planning to spend this much, even for business on logistics. It's probably best to just rejig your whole budget in order to adapt and possibly, just see where you can get some marginal gains on other budget line items. It's also the best time to build cash buffers for future expenditures, investments, and unexpected events. Again, I'll just use, because it's really fresh, the recent fuel hike. So perhaps you, as a business, you hadn't budgeted for more logistical cost or fuel cost, even as a household. It's very important to have these cash buffers. If you hadn't looked at the finance bill and perhaps it just caught you off guard, and now your payslip is not as big as it used to be. So it would have helped if you have an emergency fund, because it would need some sort of lifestyle adjustment. So those are a few nuggets of perhaps suggestions and recommendations, and I'd like to end there, and I'll just thank you for listening and bearing through my slides and presentations. Thank you.
Thank you very much, Kedi, for that insightful and comprehensive coverage of what's happening in Kenya. Indeed, we don't live in a vacuum, and this is the environment that we are currently, going through. So a few, key highlights from, Kennedy's presentation. One is the elephant in the room, Nikunoma, like it is hard. T for tough. And then the other thing he says is taking stock. So he talked about 2 dates, March 2020, that's patient 0 on COVID. Then talked about Feb 2022, when Putin pressed, the red button and we went into war. And then he said about, our peculiar economy, Michael Joseph's famous, term for Kenya, but we are indeed a peculiar economy. We had steep losses, then a steep recovery, and then the things go down from there, increased in debt, weakening shilling, inflation, even talked about food and fuel inflation at 13%. He even talked about climate change being a multiplier, and he talked about capital markets, and he ended with purchasing power, and then saying we need to reevaluate our decisions. And so what? So he's given us all this information that's quite useful for us in the economic industry. But you as a Mama Mboga, you as a head of HR, you as your business owner, or whatever other business you are doing as our audience, what is that? So what in terms of what Kennedy has talked about? And we live in Kenya. We were not going outside of this country that we are in. This is in Jotuko. So our next speaker then comes to connect the dots. He comes to connect what Kennedy has said with what we can do. So allow us, just before our speaker comes, to just changamsha. And for those who don't understand Kiswahili, it's to challenge. Maybe you can put in the chat what changamsha means in English. Let's help our non-Swahili speaking audiences. But let's changamsha our heads before we get to know what happens. So the same rules apply. The same rules apply. The first correct answer on the chat will be our winner. If you put in the Q&A, if you put anyone else, you don't win. Right, so let's go to the next one. How much do you know about our country? So you talked about PMI and exports and imports. So I go to the question, What is Kenya's top export product? What is Kenya's top export product? I know we are known as a net importer. We're always importing oil, and the cost of oil just affects us crazily, but we do export. We've tried, Kenya, we've tried. So we do export. What is our top export product? So I'm seeing some answers coming in. Let's see, give you a few seconds to put in the answers. All right, great. Wow, chocolate. Is that, what's that? Chochea. Oh, well, chochea is Kiswahili still. Chochea doesn't help with our non-Swahili speaking audience. So let's continue with that. Correct. So James Mburu, you are right. You're the first correct answer. Tea is Kenya's top export product, and to be specific, black tea, but tea nonetheless is Kenya's top export product. So to the next question, get ready. It's similar to the first one. So if you're in Google, do exports, and here we go. So Africa is Kenya's biggest export market. So which country in Africa is Kenya's largest trade partner or export market? The answer is already there. It is a country within Africa. So which country in Africa is Kenya's largest trade partner? Which country in Africa is Kenya's largest export partner? All right, so we have an answer. Festus Chesire Kiprop. Hey, okay, you're the champion for our quiz today. You got an answer in the first session, and you've gotten a chance as well. So the answer is correct. Uganda is Kenya's largest trade partner or export market. So the last one is the last one. Let's see if it's the last one. All right. So it's CICAM. It's about us today. How many yield-based funds does CICAM have? So it's 2 in 1. Eh? How many yield-based funds does CICAM have, and what are their names? So you'll put the number, a dot, and the names. Anyway, put the number and the names. So how many yield-based funds does CICAM have, and what are their names? So let's see what you have. Don't just put the number. So put the number and the names. The number and the names. So the number of yield funds we have. So yield, for those who don't know, is the same as interest rates. At least you'll know something new today. Yield, in general terms, is the same as interest rates. In general terms, all the economists and actuarial and CFA charter holders will be judging me for making that statement. But in the case of, for the sake of this question and for the sake of the quiz, yield is interest rate. So how many funds do we have as CICAM that are interest rate based, and what are their names? All right. I'm seeing good attempts, but not the right answer yet. Good attempts, but not the right answer yet. Okay. So I have seen the correct answer finally. Thank you. And the correct answer goes to Chris. And the answer is we have 3 that are yield based. So we have the money market fund, which is the largest in East and Central Africa. Please clap for us. And thank you to you. We do have the largest money market fund in East and Central Africa, sub-Saharan. Yeah. And then, sorry, Chris, no, I read it wrong. It is Timothy. We have 3, so it's money market, dollar fund, and wealth fund. But Timothy, let's give the chance to someone else because you are part of us. So obviously you would know the answer. There we go. So OO is the next correct answer. OO, please, you'll have to give us your details. So the 3 of them is money market, dollar fund, and wealth fund. OO, please give us your details so that you can know who you are and you can be able to give the price to you. All right, so at least now, if you don't go with anything, at least you know our funds, a bit about our funds, and that there are 3 of them that are yield-based, and you can use yield interchangeably as interest rates. So the next time you're talking with your friends, you can say, the yield for the money market fund and all that. But yes, so allow me to then welcome our team leader in wealth management, and her title gives you, guidance. She leads the team with regard to wealth management, not just anything, wealth management. And that's what we want for you, to be able to be wealthy people, irrespective of the economic times that we are in. She'll give us some interesting nuggets for our consideration. So thank you, and over to you, Sylvia.
All right, good afternoon, everyone. I'm happy to see you all, and thank you for joining us. My name, as you have heard, is Sylvia Kimani. I am a unit trust advisor and a team leader at that. So I'll be happy to share the slides with you and take you through what we have for you. Thank you. So as you have heard from Kennedy, we would like to walk with you this journey. We understand that these are very tough economic times, but we appreciate the fact that Kenyans are very tough too, and we are a resilient nation, and that puts us in the right position. So we will start by talking about one of the financial people who says that it's not about how much money you make, but about how much you are able to keep, how hard it works for you, and how many generations you are able to keep it for. So we will delve right into it and look into what financial planning or money management is. And you realize that this is an ongoing process, which helps us to just make sensible decisions about money. And this helps us achieve what our goals in life are. So the process for us is how we are able to spend the money, and as far as money management is concerned, how we are able to save this money and invest it. You have heard a lot from my colleague Kennedy, and we would want to walk the journey with you, even as we start to dissect this, and as we walk this journey with you, just so that we can be able to make it realizable. So money management is actually a constant analysis of what we are able to spend. And if you're able to be a person who documents this, even better. So once you're able to document your spending, then you look at what is remaining in as far as saving is concerned, and you don't leave it at that. You move on to the next angle, which is investing. And so what we are talking about here is we're saying, keep your spending to the bare minimum and focus on what your needs are and some of what your financial wants are, so that you can maintain financial discipline. So what exactly do we save towards? For most of us, how we are socialized, we are blessed and are able to have families. And for us who are hoping to have some, this is one of the things that we would recommend that you save towards. So this, you can actually save for your education, for the education of your children, so that it doesn't catch you off guard. Yet these children are always with us, and you are even able to know when it is they're going back to school. So you can also save towards emergencies. As you know, we are cultured as a social country. So we always extend ourselves to our family members, and eventualities and hurdles always take up most of our finances. So it is always good for you to be caught when you're prepared in case of an emergency towards our loved ones or our family members. So we also save towards procuring or purchasing an item that you plan for. This could be a home, it could be a car, it could be a phone, it could be a laptop, or a piece of land. So whatever you would like to be able to purchase, you can actually save towards the same, and all these things are achievable. We also recommend that you start saving towards a project. This could be a business that you have in mind. Maybe you would want to keep poultry or cattle, or just do farming in as far as product farming is concerned, or just any other project you'd have in mind. You can actually save towards the same so that it doesn't catch you off guard and you can be prepared. We also recommend that you save towards your credit worthiness. This basically means that you need to be able to honor your debt obligations as and when they fall due, so that if you have a project in mind and maybe you had saved and did not have enough in terms of finances to be able to cater for your needs, you can be able to extend yourself to a credit facility and enjoy the services that they are able to offer to you. So we also save towards what, as you can see there in the picture, is comfortable retirement, so that we can be able to enjoy our years ahead with comfort, since we work so hard to maintain ourselves and just sustain ourselves and our family members. It is important that as we look forward to retirement, we can be prepared for that eventuality. So those are some of the things that we look forward to in as far as saving is concerned. So where do most of us lie? Usually this is, I don't know whether it's the same for you, but this is what happens for me. When I am paid, I feel very happy and excited. And I feel like I can actually knock someone off down and pay them. And that is always something that I look forward to. And unless the salary is late. So I don't know that this applies to you, but it is important that we get prepared every time. So here we're looking at a payday cycle of life. And usually when you receive your first pay, the first thing you want to do is that thing that you have been looking at over the window as you are walking around in town. You would want to treat yourself to it, because, I mean, we tell ourselves we need to thank our bodies for the hard work that we do. So you go out there, you treat yourself to something nice because you are feeling that you're financially secure. Then you also go ahead and eat that you have been missing for the whole month towards when you are getting broke. You start eating good food and drinking nicely until you realize, oh, I actually have responsibilities waiting for me. So you have a thought, a pause, where you realize that life is happening. But then you're like, you know what? I work really hard. I need to do something for myself. So you go ahead and you buy that you like. And then you realize in the evening when you get home that your finances are not where you are when you are paid, and they're actually less. So you call yourself to a meeting and start to ask yourself questions as to what exactly you have done. Before you know it, you have gone, spent most of the money and cannot account for it. So you have maybe like 2/3 of the month remaining, and this, whatever you have remaining with you, is supposed to sustain you until the next payday. So we are hoping that you don't get to be the one crying out there for help every now and then, and so that we can walk this journey with you. So what are we recommending? We're saying here that we would like you to be able to manage your money. So how do we manage your money? You need to organize yourself. So the first thing you do is you prioritize and you set strict limits on spending. Basically, all you're saying is you need to tighten your belt, because these economic times, as Kennedy had mentioned earlier, are not as easy as we are used to. So we need to just look into what it is we're spending on and just buy what we really need. And then secondly, we need to have a money mindset. So money mindset, I think for most of us who've been able to log in or are actually listening to this webinar, you're already at the right place. You're already doing the right thing. So this entails you learning about how to manage your money, how to live a good percentage below your income. Then thirdly, you need to track and plan your finances. So this means that you get to spend less than you earn, you avoid excessive debt, and you adjust your household spending by budgeting accordingly. And then fourthly, we recommend that you compound or enjoy compound interest, make it your friend. So we are saying that you need to invest early and as frequently as possible. This could be as easy as daily, hourly, weekly, or monthly. But when you purpose to invest, do it on the regular so that you can enjoy the compound interest. Then develop a personal asset allocation strategy. Here, we ask that you divide your portfolio among various asset classes such as stocks, bonds, real estate, cash asset classes. So this provides a safety and steady income. Then know your risk tolerance. Choose a stable investment regardless of the market conditions, like take up insurance, and of course, be very careful as to where you place your money. So keep your investment portfolio diversified. This will help you mitigate investment risk and can be achieved by including different asset classes within your portfolio and different types of investments to increase your income. So what steps are we recommending that will help you achieve your financial freedom? One is know where you stand. So check your financial health, know how much you make, of course. This could be from various income streams over and above your salary. And what do your expenses look like? How much do you usually set aside on a monthly basis? So then next we set goals. So here we need to identify what motivates you. This could be short, medium, or long-term goals. Write them down. They could be financial or non-financial, but as long as they require your monetary resource, you need to assign cost estimates to them. Then track where your money goes. So think about the details of where you're spending, itemize what it is that you're spending on. Basically, avoid overspending on unnecessary items and prioritize your goals. So spend less on useless things. So identify whether it is a need or a want. This will help control your spending so that you can also plan your hurdles if they come about, so that you can be able to overcome any of them. So pay off your debt as soon as possible. Here we are suggesting that you knock off a debt at a time, but of course start by paying off the high interest debts first. So you remember that earlier the rates as to which people were borrowing loans were about 13-14%. As we speak currently, they're at about 18-19%. So you can only imagine how life is changing and what the debts look like. So save surplus money. And this, we recommend that you convert this into an emergency fund as soon as possible for any eventualities. So create more sources of income. These sources of income could be from the extra money you make either passively or actively. Your sources of income could be either from rental income, from your salary, from dividends for those of us who have shares or bought stocks, from interest or profit that you make in terms of a business, or even from capital gains if you have acquired something and can be able to sell it for a higher price than what it is you bought it for. So avoid lifestyle inflation. What is lifestyle inflation? This means that assuming you are being paid a salary of about 100,000, then God has been kind to you, you got a promotion and got an increment, and now you're being paid 120 to 150,000 shillings. So here, most people end up spending everything, including the increment that they have received. Yet you realize that before they could be able to get by with what they were making. So that you can avoid lifestyle inflation, we are saying don't spend everything, even the extra that you have made. If you can be able to continue surviving within the means as to which you are used to and ignore the increment, save it and invest it, you will be able to enjoy and spend. Instead of spending all your money, you'll be able to enjoy the returns of investments from the investments that you make. So invest in your future, save and invest in something that will help you and that will cater for any uncertainties that you may have. So basically what you're saying, when all this has been done, go back to the beginning, make a habit of it, make a budget and plan for your money. So you just press repeat. So why would you budget? This is to ensure that you are able to meet your expenses and not exceed them. So it teaches you, budgeting teaches you how to live within your means, how to pay for what you truly need, and also helps you not to get into the trap of debt. So let's get a budgeting method that I would like to borrow from, and also I'm happy to share with you. This method is a 50-30-20 rule. Here we start with 50% of what you make going to your needs, 30% going to your wants, and 20% going to your savings. So what do needs look like? Of course, you know, shelter is one of them. So we're talking about either paying rent, and for those who are fortunate enough, maybe a mortgage. And then we're talking about utilities. And we're also talking about getting environment for you to be able to go to your workplace just to make more money, and also food. So what is a want? I'm sure we already know what our wants are. Like that gym membership, even though health is important, it is a want. But we can actually work out from home and avoid paying the extras. Eating out, you could reinvent yourselves and have someone cook every now and then, and that doesn't have to just be you. You can find a way to make it work for you and your family. And as far as savings are concerned, at least 20% of your income needs to go there. This is towards saving for emergencies that as you had earlier mentioned, and also contributions for pension and savings account, and lastly, investments. So it is important that you get to understand what your risk tolerance is, because you are aware that anything to do with investments involves risk and return. So here we are hoping to have you build on your wealth. And it is important for you to understand that you need to know what your time horizon is. Do you want to invest for a year or more? Could be 10. So we are able to walk the journey with you. Are you saving towards an emergency fund? So what does TT Munga say? TT Munga says, the habit of saving in itself is an education which you're receiving today. It fosters every virtue, teaches self-denial, and cultivates a sense of order. It trains to forethought and so broadens the mind. And our prayer for you today is that you are broadening your mind. So what investment options are available to us? We have cash deposits, and you can also invest in unit trust or mutual funds like we do. You can also invest in bonds, which are more long-term, medium to long-term. You can also invest in shares, which are high risk, high return, or offshore, depending on what your risk appetite is or what it is you would like to invest in. So here we would like to talk about capital preservation, which basically means that you are preserving the principal. So assuming you make an investment of 10,000 shillings, we are saying that these 10,000 shillings, once you place money or invest it, should remain as it is, and all you should be able to do is enjoy whatever returns it's able to make. So capital preservation is very important. And as Kennedy had earlier mentioned, so is inflation protection. So here we are trying to make sure that the value of money that you had, say, last year, can be able to procure for you what it is that you would want to buy, given that you are protecting it from whatever inflationary rates are going on in the market. So what investments are able to cater for your principal and inflation? These are bank deposits, treasury bills, and commercial papers, which you invest in. And collectively, these are actually money market schemes. So what does CIC have to offer you, seeing as we have talked so much today? We do have a money market fund and a dollar fund. So in the money market fund, we invest in the fixed deposits, on call deposits, in treasury bills, and commercial papers. And why should you be able to invest in this fund? Because it offers you the security and is an investment vehicle where you are able to earn interest. It is a low risk, low return investment, which you can invest with as low as 5,000 shillings. And the return is fair, and it offers a better return than you otherwise would receive in a savings account. And the interest that you earn here is usually credited at the end of every month. Our recommended period is usually 12 months, but should you have the money longer than that with us, we are still able to continue to give you whatever interest we are offering at the time. This fund offers you accessibility in that you can be able to liquidate as and when you would like to receive your funds. As you know, currently as we speak, liquidity or cash is king at the moment based on the opportunities that are going on in the marketplace. So the other fund that we have for you is a dollar fund. And I know that this is ideal for clients who maybe have children who go to international schools or pay in dollars, or for traders who do have a lot of imports or do a lot of trading in the currency. We are able to offer this fund for you, and we invest in also fixed deposits or Eurobonds. And this offers you some currency diversification. It's also a low risk kind of fund. And the minimum investment is $1,000. The fund also gives a fair return so that you're able to enjoy some returns on the money that you have placed with us. And you can actually access just like the money market. So why should you invest with CIC Asset Management? CIC Asset Management is able to offer you diversification. You can get to own a share in a diversified portfolio instead of investing all your resources in just one asset. Then we are able to offer expert advice and opinion because we make our investment decisions backed by research and a market analysis team which constantly monitors the outcome, which leads to better performance. We also are able to offer you the flexibility so you can be able to contribute as and when you have more money and would like to add on to the investments that you currently enjoy with us. And this, we allow you to get to a very huge portfolio. We also offer liquidity, as we mentioned earlier and repeatedly. You can access your funds on investment within 2 to 4 working days, either via M-Pesa or bank, depending on the platform that you find convenient with you or for you. We are able to offer transparency, information and communication flows really well. Statements are issued on a monthly basis, and account opening for clients, you're notified via email and text. We offer competitive returns so that we are able to seek and outperform similar investments. So you're in a good place if you choose to invest with us. And we offer low entry points. Like I said earlier, for the dollar fund, it's $1,000, sorry, and 5,000 shillings for the money market. So like we said, why us? As you can see on the chart, we enjoy a great market share. And this is because of the support that you've accorded us and the faith that you have in us. We thank you for it. And we pray that moving forward, we'll be able to get more clients from you with testimonials for the good work that we are doing. And we hope to be able to continue to do great work. So if you don't take anything else away from what I was able to say, I'll just wrap it up and just give you the financial rules. So always live below your means, save at least bare minimum 10% of what you earn, track your spending, create and follow a budget, buy that thing that you want to buy. If it's a car, if it's a home, at least one that you can afford. Pay off your high interest debts, set long and short-term goals, invest in mutual funds or any other investments that tickle your fancy, maximize on saving for your retirement, protect your loved ones by taking up insurance, and also save up for an emergency fund and make sure that you have a will. Thank you. It's time to harvest, but you can only do so where you have planted. Kindly register with us today or pay us a visit at any one of our branches.
Excellent. Thank you. I've seen we already have some claps in the audience. Yes. Thank you very much. Well done, Sylvia. Very insightful. Very insightful information that you've given us this afternoon. I think just to highlight, I know we've run out of time. It's 4:43, so we'll try and catch up on time. But just to highlight what she said is have a money mindset. So learn, which is what you're doing today afternoon. Tighten your belt, track and plan your money, diversify. And she's given us multiple options on what you can do with the money. The money market fund, the dollar fund, as well as many others that you can do and manage your debt. And generally, she's also given us, a nice nugget to take home in terms of information. So I'd like us to go to the Q&A session. I know there's some of you who have asked for the presentation, so we will have part of the presentations and also snippets of these videos on our website in a few days' time. So I'll ask to clean it up and post it on our website. So I'll go to the first question. Actually, before I do that, so Josephine Moneki, thank you. You're able to interpret for us Changamsha, which means psych. So for those who don't speak Swahili, I've seen some of us, some of our Malawi colleagues and clients who've joined us. Changamsha means to psych, to give psych. So off to the questions. I'll start with the first one from Ruth. Are we in a recession? And how long can it last from economic trends? So basically, are we in a recession? And if we are, how long can it last? So Kennedy will take us through that, and then we'll continue the Q&A.
Thank you, Bothoni. Thank you, Ruth, for the question. I'd say the black and white answer is Kenya is not in a recession. The gray answer is that there are significant risks that could push Kenya to a recession. And this would mainly emanate from inflation and especially our debt situation. So if, say, next year, especially when, our debt situation is going to be at its peak, June 2024, where we have a $2 billion loan coming up for a one-off maturity. if, say, the country won't be able to meet that obligation, this could tip the scales to, sort of very hard economic situation where we could see signs of a recession. However, all the indicators to show that a country is in recession, let's say negative GDP growth for subsequent quarters, that hasn't been seen. Now, globally, there is a lot of talk about recession. There is not concrete consensus. And I'll just accentuate this with a joke about economists. What happens when you put 10 economists in a room? You get 11 opinions. Or did you know economists have predicted 9 out of the last 5 recessions? Just to give you a view that economists really don't really have a consensus on these things. But yeah, just to straight up answer your question, the black and white answer is locally, no. Globally, the verdict is not yet out there. Thank you.
So we just had an economic version of a dad joke, but sorry, but yeah, good, good one, Kennedy. Good one. Right. So let's continue with the questions that we have. Thank you for that elaborate answer. And simple, are we in a recession? No. So the next question from Kirui B. Kibeti says, how do you deal with the fact that 100K in January has depreciated in value by December? I mean, how do you deal with that? I think Sylvia has talked a lot about it, but maybe she can summarize it in a few words on, how do you deal with the fact that 100K in January is not the same, even in September, and will probably not be the same by December.
Well, Kirui, good evening. So thank you for your question, Kirui. We are in very interesting economic times. If you realize this is something that is affecting us globally, and even inflation is just affecting us as much. So what we're saying is we need to tighten our belts, and that's a reality. So 100,000 might not be equivalent to what it could procure today, but we are saying that if you actually invest this money, there is something more that it could buy for you. You could invest it, and whatever returns you're able to receive, for sure, if you give us 100,000 today, by the time the end of the year has arrived, we will not give you back as 100,000. It will be 110,000 or more. So basically what we're saying is you need to invest this money for it to give you value so that it can keep up with the tough economic times and be able to procure what it is that you need to invest in or buy or purchase when it falls due. So tighten your belt, save, and invest. Of course, just use or spend on what you truly need and not anything that you do not require. Thank you.
Great, thank you, Sylvia, for that. Again, another concise response to our questions. So let me look out for the other one. So this one is is it 2 phases? It's 2 questions, but I'll direct the second one to Kennedy, and it's on de-dollarization at BRICS. So the question is, comment on the de-dollarization at BRICS countries during the 14th summit. And thank you, for, do I say to God that I was able to say the word de-dollarization without, slaughtering the word. But yes, over to you, Kennedy. Comment on yes, that word at BRICS countries during the 14th summit.
Well, thank you for the question. It is an interesting conversation. I think I'd want to highlight there's just a key number when it comes to de-dollarization. The fact that I think approximately, I can be corrected if I'm wrong, 40 to 50% of global transactions do happen in the dollar, and it won't be as easy as just transitioning from from the dollar to another currency. While now the BRICS is going to be a stronger bloc in the sense that now they'll be controlling around perhaps 60 to 80% of the globe's oil production, which could give them more room to sort of decide what currency they will be transacting in. But I think in a nutshell, I'd say it's quite interesting. We might see some easing off using of the dollar, but the period in which it will happen is probably longer than expected, than most market sentiments are. But also perhaps Muthoni is also quite knowledgeable on this. I would invite her to maybe also give a brief comment about it.
Thank you, Kennedy. But today you shine. But I think you've captured it quite well. Yeah, you literally have captured it quite well. And I would say I wouldn't want to add to that and water down the response. But similar to what you've just talked about is a question on what is your contingency plan and your diversification strategies to mitigate risks, especially with government securities? Should it start facing challenges in meeting its obligations? That's a tough one.
I think currently, like we mentioned about cash buffers, there's a tagline in the investment world where sometimes in periods of volatility, cash is king. So in terms of diversification, so yes, you can go for, let's say, investments in terms of also inflation hedged investments, and also in terms of debt risk, you would try and go, try and invest short, such that the risk associated with possibly a default is reduced, because your money is not parked in the long term and you're sort of hedged on that. But also this is again Muthoni's domain, so I can invite her to also accentuate what I'm talking about.
All right, thank you, Kennedy. And just again reiterating, cash is king, and also diversification in and of itself is one of the ways you can mitigate risks, and you have answered yourself in your question. So diversify in terms of the asset classes, in terms of the regions that you place in, and just to mention that should a government default, the financial industry and in fact the economy of that country is strongly, gravely and negatively affected, and it's not a place where I would want to be. The banking, in fact, all financial sectors would be affected negatively. It means even manufacturing and other people wouldn't have access to debt, because a lot of people invest in the government securities. But how to mitigate that is then to spread. Don't put all your eggs in one basket. Don't put everything in government securities. Invest in other financial institutions that are also diversified. So we are running out of time. So allow me to combine questions and just, which is simple. What's your take on the purchase of CIC dollar fund at the moment, given the shilling is depreciating, and combine it with, is it advisable to invest in USD now? And so I'll allow Sylvia to take that question as the last one, and we will respond to these questions. And if you just wait, we will be able to respond to them on the chat, just in the interest of time. Thank you.
Okay, so good question, sir. And we do recommend that you invest in the dollar fund. One of the reasons is because you can actually enjoy what we call an appreciation in terms of value. So assuming you were to buy a dollar today at 140 or 150 Kenya shillings, and then maybe by the time you are trying to liquidate, you find that the dollar is at 180. Already in itself there, you've enjoyed valuation in terms of currency. So you've mitigated what you call valuation risk. And also, even as you're placing or investing in our dollar fund, the fund in itself will not just be seated. It will actually be accruing the current rate of interest return that we'll be offering to you. So it will be gaining twofold, from capital gain and also from the interest earned.
All right, excellent. Thank you everybody for attending. I think I'd like to hand over to Kibe for us to close. Don't log off. We will respond to your email, to your questions on the chat for those who have put in questions. Thank you.
Thank you very much, Muthoni, our host this evening. Thank you, Sylvia, for giving us the solutions to the problems that Kennedy did a very good job in painting, but we have problems with solutions. I think my take home is that everything is connected. When you feel some heat in your pocket, just know that that is translating probably from more taxes, and that the taxes are being picked to pay the national debts, and that tough times call for tough measures, and we have been given the solutions to which we can solve some of our problems. It has been an enlightening session. I hope that each one of you has learned something. And as we go home this evening, we take home something with us. I want to thank each and every one of you for taking the opportunity to join our webinar this evening. And we will be doing more of this. We will be seeking for feedback from you on topics that you would want us to discuss in future. And we will keep educating, keep informing, and making sure that you have relevant information that you can use to make informed decisioning. That has been our financial decisioning webinar. We thank you for joining, and we'll close with a word of prayer as we set off for the evening. So let's bow our heads for a word of prayer. Thank you, Heavenly Father, for this evening, and thank you for the engaging and insightful session that we've had. We pray that as we dispatch and we go to our various destinations, Lord, you protect us and be with us this evening. We pray this, believing and trusting in Jesus' name. Amen. Thank you, everyone.